Hey everyone, welcome to today's Explainer. Today, we're taking a look at a really fascinating brand new piece of legislation that's basically going to rewrite the rules of commerce in Vietnam. We're talking about Decree 254. Now, I know what you're thinking. Dense legal tax documents aren't exactly thrilling weekend reading, but that's exactly why we're here. We've gone ahead and synthesized all those crucial dates, frameworks, and legal jargon into a clear, straightforward breakdown. By the end of this, you'll know exactly what this decree means for the wider economy, and more importantly, how it's going to impact you directly.
Okay, let's dive straight in. July 1, 2026. Mark your calendars because this is the date you really need to memorize. This isn't just some soft suggestion from the tax authorities. It's a hard, non-negotiable deadline. This is the exact moment Decree 254 officially takes effect, completely sweeping away the old systems and kicking off a fully digital era for all invoices and documents. The clock is officially ticking, so it's time to get ready.
To make this easy to digest, we've broken the decree down into 5 quick sections: the 2026 e-invoice era, classifications and subjects, timing of invoicing, support and free services, and finally, consumer rights.
Section 1, the 2026 e-invoice era, the government's vision.
Let's start with the macro view. Like, what is the government actually trying to achieve with all this? Well, Decree 254 is a comprehensive mandate meant to legally replace older frameworks and establish a fully mandatory digital and transparent e-invoice ecosystem. The ultimate goal here is total modernization. We're moving completely away from those fragmented, easily manipulated paper trails and moving into a centralized digital system where every single transaction is recorded, standardized, and transparent. It is a massive, massive upgrade to the country's tax management infrastructure. Section 2, classifications and subjects, the seller's reality. So that's the big picture, right? But what does this actually mean if you're running a business? Well, you need to understand the core difference between the two main types of e-invoices mandated here. First, you have invoices with a tax code. For these, a business has to send the invoice data to the tax authority first, get a unique code generated by their system, and only then can they send it over to the buyer. On the flip side, we have invoices without a tax code. These can be fired off directly to the buyer first, but, and this is a big but, that privilege is strictly reserved for specific, highly regulated sectors. We're talking telecommunications, banking, airlines, basically industries that already have massive, highly secure IT infrastructures in place.
And if you're wondering who exactly is caught up in this digital net, the scope is incredibly broad. It covers domestic enterprises, local business households, and public service units that sell goods. But take a close look at foreign e-commerce platforms. Even if a digital platform is based entirely overseas, if they're generating taxable revenue within Vietnam, they are required to comply. The decree leaves virtually zero loopholes here.
Now, because it is such a comprehensive law, there are some practical exceptions. You don't need to issue standard e-invoices if you fall into some very specific categories. This includes individuals making income from renting out real estate, small business households that just use standard purchase lists, lottery and insurance agents where taxes are already deducted at the source, and certain specialized financial transactions like capital contributions with assets. So if you're in one of those niche groups, the decree does acknowledge your unique operational structure.
Section 3, timing of invoicing.
Article 9 of the decree gets pretty deep into the legalese, but the timing of when you actually have to hit send on that e-invoice is strictly regulated. So before we get too into the weeds, here's the golden baseline rule you really need to understand. Invoices must be issued at the exact moment ownership is transferred or the moment a service is completed. And here's the kicker. This is entirely regardless of whether you've actually been paid yet. The trigger is the completion of the transaction itself, not the cash hitting your account. But of course, for some industries, that golden rule is just way too complicated to practically apply. Take construction and real estate, for example. Invoicing there happens upon the physical handover of the project or at scheduled payment milestones. For high-volume data industries like airlines and insurance, they actually get a grace period until the 10th of the following month to reconcile all their data before invoicing. Meanwhile, casinos and gaming operations, they have a super tight 24-hour window to invoice after determining their daily revenue. It's a surprisingly tailored approach for different sectors. Section 4, support and free services. Look, forcing an entire country's economy to suddenly digitize is a massive undertaking, especially for smaller businesses. So how is the government actually easing the pain of this transition? Well, Article 11 outlines some specific relief.
If you're a small or medium enterprise, a co-op, or a business household operating in a designated, difficult socioeconomic area, the government isn't just going to slap you with a fine if you can't afford the new software. Instead, the tax authorities will provide state-funded, entirely free e-invoice services to help you bridge that digital divide. And that support isn't just a flash in the pan. It lasts for exactly 12 months. Starting from the very first day you use the e-invoice system, eligible businesses get a full year of free service. That gives you time to adapt, train your staff, and seamlessly integrate into the national ecosystem without dealing with that heavy upfront financial burden. Section 5. Consumer Rights. And honestly, the plot twist. This leads into what is arguably the most fascinating part of the entire decree. This whole thing isn't just about businesses and the government. It's actually about you, the everyday consumer. Under Article 18, buyers are not just passive players in this new ecosystem. You have protected legal rights. You have the fundamental right to demand a legal e-invoice for your purchases. And this isn't just to keep businesses honest. It allows you to officially prove ownership, confirm transactions, and, here's the really cool part, participate in government tax reward programs that actually incentivize you to ask for those invoices. Which brings us to the plot twist in Article 41. 10 million Vietnamese dong. If you are a consumer and you buy something from a business that flat out refuses to issue a proper e-invoice, you can report them. And if your tip leads to a verified penalty against that business, the government will actually reward you with up to 10% of the administrative fine they collect, capped at 10 million dong per case. The government is literally turning every single consumer into a localized compliance auditor. How wild is that?
And they've made the process incredibly frictionless. Step 1, you just gather your proof, like a photo, a receipt, or a transaction record. Step 2, you submit it directly through the eTax mobile app, the National Public Service Portal, or even just via direct email. Step 3, you literally just wait for the tax authority to verify the violation, issue the penalty, and then you claim your reward. It is a highly efficient, completely crowdsourced enforcement mechanism.
To wrap things up, we have to look at the absolute final timeline mapped out in Article 44. Like we talked about earlier, July 1, 2026 is when Decree 254 officially takes effect. But there is a very brief grace period. December 31st, 2026 is the absolute last day anyone is allowed to use old, self-printed paper receipts. By January 1st, 2027, the decree legally mandates that all unused paper receipts must be physically destroyed. The paper era doesn't just slowly fade away, it is definitively, legally terminated. Which really leaves us with one pretty massive question. With every single transaction digitally tracked, consumer watchdogs actively incentivized with cash bounties, and old receipt books literally ordered by law to be destroyed, in this fully transparent digital economy, is paper finally dead? It's a huge, fundamental shift in how commerce operates, and it's approaching fast. Thank you so much for tuning into this explainer, and I highly encourage you to look a bit deeper into how these incoming changes are going to impact your own operations. See you next time.